since January 17th, 2018, when the Dow peaked, the Dow has since traveled a cumulative 58,000 points. That's up and down. 58,000 points. And in all that time, the net gain for the Dow is just 40 points. Think about how much noise we've endured over 15 months. But now, the S&P 500 is at the highest point since just before that big October flush. Now you got transports up big yet again. Now you got stocks like Cisco going bananas, large cap, big names that are not expensive stocks. You've got semis up big. The banks are acting well. So, yeah, if you ask me, like, what is the weight of the evidence? What do you think is the most likely? I really don't think it's going out on a limb to say we're going to go ahead and test that old high. I hope we get through it. We'll see what the volume looks like. We'll see how internals are acting then. But 10 days ago, we were screaming about recession and inverted yield curves. And we had the very worst guests you can imagine coming on every financial network and giving quotes to the newspapers that recession's imminent. And look how quickly price changes sentiment and changes the rhetoric, changes the tone.
Liz Ann, broad-based rally, as Josh said, what's not to like?
Well, the breadth has been great. We've got a couple of breadth thrusts, kind of in the whole idea invented by my first boss in this business, Marty Zweig. So that's a good technical underpinning. And I think this rally continues to be healthy. Some of the cracks that you had started to see with the lack of participation, Josh talked about it, by the transports, that's turned around. You've got the cyclical bias. Again, I think, though, that really important in the near term is what we see during earnings season, not just companies reporting relative to what has been just an unbelievable slash in Q1 estimates down into negative territory, but what the outlook expressed is for the second and third quarters, where you only have marginally positive earnings. So I think that's the next big hurdle that the market has to get over. Whether we can get to new highs in advance of that, I don't know.
John, is this justified, the move that we've seen? Do earnings expectations, sort of where we are, this run that we've had since the bottom of December, is justified?
Yes, justified. And with the China manufacturing numbers that we got today and impact, I mean, this is the first time in 4 months that they've gotten back over 50, highest reading since July of last year, I believe, out of China. We've also got Draghi talking about the stimulus that they've got to apply. They will apply. That headline out this morning, that certainly didn't hurt. I think we're going to see this bar stepped over very easily by a lot of these companies because the numbers have been taken down so far, Judge. And even with bad numbers, like there were several stocks that had not great numbers today and still moved up by 5 and 7 and 8% because of short interest being so large in some of these. So do I expect it to continue? I do. And I think that the numbers for the first quarter as they start to come out are going to reflect exactly that.
All right. So I mentioned our exclusive halftime stock survey. And Jim, I'm going to lead to you with that. Of all those we asked, 81% say stocks are correctly valued right where they are. The most stunning thing is that the overall outlook, nobody is negative at all. 0%. Of those that we asked about the stock market right now, 70% are positive, 30% are neutral, 0% are negative. That cool?
So we must not have had any bond managers in that survey, I guess, Scott. But no, look, I'm in that camp. I do have to say, though, the thing that worries me here is we're talking just a second ago about China stimulus, and we're talking about monetary stimulus, a Fed on pause, maybe even a rate cut this late in the cycle. That actually gives me a little bit of pause. I think Liz Ann Sonders has a good point here that, you know, earnings expectation, you pointed out we're at fair value, everybody says. Yeah, around 17 times what this year's estimates are. Can I point out that this year's estimates on the S&P are 167, down from 180 about 9 months ago. So that shows you that, yeah, we're at fair value. We would have been cheap if those earnings estimates had stayed where they are. What I'm telling you is the second half of this year, you have to see a pickup in earnings for this market to go higher. How do you get that? I think the only way you get that is a significant easing of trade tensions, not just with China, but also with the EU. If you get those two things easing, maybe you get past Brexit, you start to see earnings growth again. You need that.